Is AI a bubble, or what exactly is the bubble that might be causing the stock market to crash? I'm going to explain Michael Burry's logic and what he's looking at as far as GPUs and the overvaluation of a lot of these companies. You can make your own determination if it's right or wrong, but we will go into some of the riskier companies and what they're doing and how this could potentially be fraud down the line. I also want to address, a lot of people pushed out Michael Burry's trade. Again, to clarify his trade, he even posted it. It's not 900 or $1 billion. He spent around basically 9.2 million. And it's a lot of options. Just to give you for instance, you can go in and look at all of it. So CNBC even misquoted it. So it's all there for you. So if I made any mistakes, want to clarify. But what we're going to do first is jump into what exactly is Burry's argument and what's really going on. So bear with me. I'm going to hopefully answer all your questions. Okay. The core claim is what's happening with depreciation of their assets and really going into GPUs, because that's the core and central part of all of this and what's happening from NVIDIA. So Burry's primary contention is that hyperscalers are depreciating their massive capital expenditures on AI servers and GPUs over a period of time that is too long given the pace of technological advancement. Now, again, putting this simple, basically people are going and buying a new chip. Let's say you buy chip number 1, and if this is the newest, greatest AI chip out there, and people want to go out and rent this product or use your data center with the latest model. Well, that is the case. But we know that NVIDIA, and we'll go into this in a second, that NVIDIA is going to release a new chip in a year or maybe 2 years. And that's going to be the best chip out there. Well, if you're someone who wants to go rent out a product, well, who are you going to go to? The one with the newer product or the older product? You'll know you'll be paying a similar cost, but the newer product is going to be more efficient and it's going to get you better overall results. Or would you rather go with the older model and have worse results and maybe pay a little bit less? Well, you're focusing on the top companies in the entire market, like Meta, Microsoft, Google, etc. So again, in ChatGPT, OpenAI, these companies want to use the best of the best because right now we are in a race. That's the very important thing. All these companies are in a race towards AGI, and that is where everything stems from. So everyone wants the best of the best. So what happens is, well, what do you do with those old chips and how are you valuing them? That's the very important part here, because again, those have to lose value, and what is the speed in which that value is lost? The company practice. The company is currently depreciating their AI hardware over 5 to 6 years. Meta, for example, uses a 5.5 year structure on some of their assets. Again, some are different, some are longer, some are shorter. Burry's argument is that the rapid product cycle of high-end GPUs for companies like NVIDIA is only 2 to 3 years. A new, significantly more powerful and energy-efficient chip comes out every 2 years, rendering the old generation economically obsolete for most demanding tasks like training large foundation models. The accounting result by spread of the cost expensive chip over 5 to 6 years instead of 2 to 3, the annual depreciation expense is lower. So basically giving you an idea how they're able to write off these claims and show how much money they're making. Okay. So if a chip is expected to last 3 years, you can write it off however long you want. Some companies go even like to 10 years, right? Very few, but some companies have done that before. And so you have to understand what they're doing is, again, you're buying a product for, let's say, $1 million and you're getting $1.5 million out of it. But they're able to stretch that out and say, okay, well, since we're going to stretch out into 5 overall years of uses, if we're making $1 million, let's say, each year, then I'm only using $200K of expense for that first year. Now, what happens is you get to the year 3, and your profits or your cost is showing around $600,000. I'm using all hypothetical numbers of $600,000 in cost. But you've accrued $4.5 million of revenue. So that's showing that you made a good bit of change and you made some good money. But the question is, going to year 4 and year 5, are you able to use those same products, or do you have to sell them or get rid of them? And then what are they valued at as well? And that is the real problem here, is that's a lot of stuff in the air. And we're so new to this that we really don't know. But you can go look at the resale market on some of these chips and tools, and it's not really that great. I'm not going to say they're worthless, but it's not like you're getting a lot of your money back. Again, we have to understand that. The analogy, a 60 million machine depreciated over 6 years expenses $10 million per year. If it were depreciated over 3 years, the expense would be $20 million per year. The financial effect. Their artificially lower depreciation expense artificially boosts reported GAAP earnings. In the short term, making companies look like they're more profitable than he believes they actually are. Burry's estimated this could inflate profits across the industry by hundreds of billions of dollars over the next few years. And again, I don't think the question necessarily is NVIDIA. It's the companies that NVIDIA is selling these chips to. Again, when we use the idea or the analogy of the gold rush, again, they're just selling all the tools and they can't sell them fast enough. That's what's happening. The economic reality versus book value. And I would just take a screenshot so you could do the math for yourself, or even type this into ChatGPT to explain it for you simpler. Or you just ask ChatGPT to explain it in a simple way. The economic reality versus book value. Burry argues that companies are confusing physical utilization with economic value or profitability. The counter argument, the company's view, like Meta, CoreWeave, and these other ones. Companies argue that older chips are cascaded down to handle less intensive values and workloads and tasks, right? Like AI inference or general cloud computing, meaning they still generate revenue for the next 5 years. Also very important. So they're saying instead of doing the top of the line task of the search for AGI, whatever it may be, that they go down to less difficult tasks and they're still being used and solve a place. But the question is how much revenue are they producing, and is it still justifying the cost of what they have? Again, this is the slippery slope. Even if they're going to a less useful area that doesn't require as much power or demand, whatever, but how much are they really making there? And does it really make sense? Burry's rebuttal, the chips become so much less power efficient compared to the newer generation that their economic benefit breaks down quickly. He points out that the operational cost of electricity on running older and less efficient chips negates the value of keeping them on the books for so long. And again, this is very true. As things age, and again, they're going to have more issues. They're going to require more power. Again, like a simple battery in your phone, which again is a lot simpler of an issue, but you'll realize when you're using your iPhone, it again gets more and more charge time. It dies faster and faster. That is what happens with these chips as well. Now, again, it's a lot more intensive. It's a lot more sophisticated. I'm using a very simple term to break this down for you. The risk of the trade right now. The ultimate risk in Burry's view is the potential for a depreciation cliff or financial hangover. Now, again, this wouldn't happen tomorrow. This wouldn't happen 6 months from now. This would probably happen a year or two from now, which again, Burry's probably really early. If the chips become obsolete or need replacement in 3 years, but are still being depreciated over 6 years, the company must eventually record a massive loss on disposal or accelerate the remaining depreciation, leading to a sudden and significant reduction in reported earnings. This perceived earnings inflation is a sign of a larger AI bubble, which he is betting against in the short positions of NVIDIA and Palantir. And it's worth mentioning, like I said, his position isn't like that insane. We've gone pretty in depth with what he's doing here. It's only about $10 million, which is honestly like a small position in comparison to his much larger trade back in 2008. Now, going into examples. Now, if you followed on Twitter, then you've already seen the example on CoreWeave, which is really important. And I also want to make the argument for NVIDIA because they addressed this problem as well here in a second. So when we go to something like CoreWeave, we went into what they're doing with earnings and what's happening there as well. Now, CoreWeave, based on their most recent earnings statement, and I'll use Nebius as well. Nebius is actually the data center company that I like the most. I'll tell you why in a second. But again, CoreWeave, and they all use different years for depreciation. So CoreWeave came out for their technology equipment is a 6-year depreciation cycle. For software, 3 to 6 years. Data center equipment, 8 to 12 years. Now, again, I'm giving them the benefit of the doubt and saying it's 6 years. But again, 8 to 12 is much, much scarier. Other assets, etc., right there. Now you go into Nebius. Server and network equipment are 4 years. You can see the infrastructure systems equipment 3 to 10, which sounds scary. But if you go down to the bottom of their statement, they say right here, our main assets, GPUs, are currently depreciated at 4 years. Nebius was very, very clear to put that out there. They wanted to make sure everyone knows what's happening there. So again, this is why I like Nebius so much, is because they're depreciating it at the, in my opinion, the best rate right now. That's worth mentioning. Now, again, you can go and take a screenshot of this and go into some of the issues that are out there, but it really just hammers home what I just said, that the issue is with Michael Burry and what's happening there. But again, you have to understand, by the longer you can depreciate these items and the GPUs, you're creating and you're making your earnings look better and better and better. So, especially companies like CoreWeave and Nebius, Iron, any of these data center companies, they're really not profitable as it is, or they're pushing margins to the best of their ability and they're rushing to generate more cash to build out more data centers. It's incentivizing for them to prop up their earnings, prop up how much they're making, prop up their margins by whatever they can. So again, their stock price can go up so they can continue bringing in money to build more and more and more. And the real goal seems like right now, again, if you look at any of these companies, is they're trying to outbuild their problems, right? That's where they're trying to get to. So it's really interesting and dangerous. But again, I still think Nebius is the best out of most of these names. I'm telling you right now. Now, going into Meta. Now, Meta is the more interesting one because, again, Burry's been hammering home on Meta. And Meta's CapEx is insane. If you go look at, that was like the problem with Meta's earnings as well, not just the tax payment, but also what was happening with their CapEx. And everyone's like, dude, they're spending a lot. And Zuckerberg came out and basically said, like, look, we're already gonna spend this much. We're hindering ourselves. If we don't spend as much as we can, we're just basically killing our profit margins down the line. Again, trying to spend to grow. It's a dangerous, dangerous game. And you have to understand that might work with growth stocks like Nebius, CoreWeave, and these others. They might continue going up. But when you're a big hitter like Meta, you know, you're a Mag 7 name. You're already established. You're making money. You could be digging yourself a hole. Who knows? Very important to understand this. And I also want to say, Meta is actually one of the more interesting plays when it comes to the market overall, because they're the only Mag 7 name right now. This could have changed today, but again, as of yesterday, they're the only Mag 7 name trading under 20x revenue, which is pretty interesting to see. And I do think they're becoming a pretty awesome buying opportunity, minus this risk here. So Meta's official statement about useful life for certain servers and network assets includes their GPUs, which is 5.5 years. Which is a really weird number to say, but still 5.5, which is better than something like CoreWeave. Okay, here's the breakdown. The official policy, Meta announced a change at the beginning of 2025 to extend estimated useful life. Again, they did this in the beginning of this year. They extended the useful life of some servers and network assets from a previous shorter period from 4 years and 5 years to 5.5. This extension lowers annual depreciation and expenses and increases reported earnings. Now, again, this is a red flag because they're increasing the lifespan. Right? You know, they already were pushing the agenda at 4 to 5, but then they increased it even more to make earnings look even better. That is definitely a concern. The debate. This policy is a current subject of intense debate among investors, analysts, critics like Michael Burry. Argue the rapid pace of innovation. NVIDIA is now having an annual chip release, which again, it's not semi-annual, this is annual now, which means the true economic lifespan of each cutting-edge AI chip is much shorter, possibly 2 to 3. Now, the industry standard is 4. That is like the standard that is already pushing it, okay? Justification for longer life. Companies like Meta justify longer lifespan by arguing that older chips, again, are cascaded down, like I mentioned earlier, and used for less intensive but still valuable workloads, like AI inference, general computing, after they are replaced for most of the demanding task of training of the new foundation models. Again, they're all using the same wordage and same terminology. So this is the part that you're like, okay, I don't like to see this, is that everyone's using the same excuses and saying the same thing, almost like they all got together and discussed this. That is the concern. Now, this was something that I don't think anyone really covered on NVIDIA's most recent earnings. You see, everyone's talking about NVIDIA's earnings being bad or a bubble because they have so much inventory on hand. In my opinion, that's not the concern. NVIDIA has a lot of shit on hand because they're fulfilling orders nonstop. And again, everything they have on hand has already been sold, which is worth mentioning. But again, people don't want to talk about that at all. So really important to understand. Like, someone had already bought all the stuff they have. It's just they're getting them in waves as they're actually paying. Important to understand that. Or data centers just haven't been completed yet on some of them. So important to understand that as well. You can go into the earnings and research that for yourself. Okay, so going into this, NVIDIA tried to help out as much as they can. And again, this is a little weird, and I don't know how to take it because NVIDIA felt the need to defend basically their customers. So NVIDIA's management strongly argued at this earnings that the useful life of their GPUs is much longer than 2 to 3 years, suggesting that skeptics are basically wrong. The real world example, the AI100, the A100, which this is actually totally true. So they basically came on and said that the A100 GPUs, based on their Ampere architecture released in 2020, have shipped several years ago and are still running at full utilization today in the cloud. Now, again, we don't have any data to back that, but that's their words. And again, the A100 is still a very popular chip out there. Software enhancements, management suggests or stress that the performance of older chips does not stagnate because software upgrades can drive meaningful performance improvements over the GPU's lifetime. Now, again, we're not backing this up with data, and we're not actually showing anything. We're just saying this, which I think is very important that NVIDIA comes out and provides data, and all these other companies provide the data as well to show efficiency. If we're not pushing that out there, and I might have missed it, I might have found it, but if I was these companies, I would be pushing that out there immediately, demonstrating what's going on. Personal opinion. Cascading workloads justify a long life. Now, again, NVIDIA acknowledged that a 6-year GPU is not used to train the most advanced frontier AI models, which, again, we know that. Okay. If you're going to want to do these AI models, you're going to want to use the best of the best. Every company that's paying for this, they're paying millions and millions and millions of dollars. For instance, Meta and Microsoft, I think Microsoft just signed a $14 billion deal with Nebius, and Meta a pretty big deal as well. I don't know the exact numbers, but again, they want the best of the best, and that's why some of them are scaling back from CoreWeave because they don't have some of the Blackwell chips yet. Worth mentioning, okay? Or at the time they didn't. However, they argue that these chips are effectively cascaded to handle less intensive, again, you hear the term, but still high value workloads, such as AI inference and general computing tasks, where they continue to generate significant economic value for years. Which again, this may be true, but we need to also understand the data center trend of what's happening. It's been going on for over a year now. Don't get me wrong, maybe going on 2, but we got to share the data. I think at the next earnings of what these companies are doing, they need to be showing each part of the business and really demonstrating. Now, again, it might not be in their best interest, but I think that's the only real way that you can disprove all these issues. Or until you get down to 4 to 5 years and you're like, okay, guys, where's the depreciation? Those are the real questions now. The CUDA ecosystem advantage. NVIDIA argued that its proprietary software ecosystem, CUDA, combined with its versatile architecture, allows GPUs to have much longer economic life compared to the competing accelerators that may become obsolete within a few years if technologies rapidly evolve. Which, again, probably is true going into this as well. We've seen some of the data on this, that, again, their upgrades and updates have been pretty solid over time, and that's why everyone wants NVIDIA over the competitor. That's why they're the top of the top. We all know this, and that's why NVIDIA sells out instantly. But again, we won't really have all the data, all the information. And then the question goes into when things get more and more intense, like with the Blackwell chip. That's going to be the question, which is the best of the best. So in short, while NVIDIA is not the one booking the depreciation, their customers, the hyperscalers, are. Again, important to know. They are aggressively defending the case for long useful life to ease investor fears that their customers are overstating their profits by using depreciation schedules. Now, again, the real problem when you look at this is that when you go into these companies, they all have different lifespans. That is a red flag to me. If I look at that, that's a red flag. Now, do I think all these companies are going to go under and explode? No. Do I believe that the bubble issue is right now? No. I think we won't really know all these issues until down the line. So what you have to do, in my opinion, is when you're making these bets, if you are making the bets, is trying to bet on the least risky of them, right? Now, you might, withhold some profits. That might be an issue, but in my opinion, that's really the best you can do right now. Now, where red flags do arise is when companies start to shift and move the depreciation lifespan. Now, I guess that would make sense if I went from like an A100 to a Blackwell, or I upgraded, significantly everything that I have. That could make sense. You can make that argument. But again, that's where we're at right now, and I don't like that we're just moving the goalpost occasionally. Again, I'm not saying that these are all going to explode. I'm not saying that. I'm just trying to break down the argument so people understand. And when you go into some of these names like CoreWeave, again, that's why the CoreWeave is getting destroyed right now. Again, there's a lot of fear and a lot of concern. The name went from $181 down to $71. Very important to understand. And again, they are not profitable. They're bringing in a lot of money, but they're not profitable. Same thing with Nebius. You go look at Nebius, they went from 140 down to 83, almost dropped to like 78 on the day. I still like them a lot, but again, there's still a lot of red flags and issues there. Iron, very similar, breaking down continuously as of now. So again, if I'm looking at these and I'm looking at, okay, which ones are going to be successful, continue to make money, I'm looking for big contracts that are solidified so we know money's going to keep coming in, i.e. Microsoft, Meta. That's why I love Nebius, and I keep saying it. I'm not trying to sell you on them. Do your own research. That's a really important factor there. And then when we go into something like Meta, again, they're going to keep spending crazy amounts of money. And, I think Meta is in that position too, where they can afford to spend a lot of money, and they're not in this like as big of a race to just build. They're going to make money as it is, and they're going to survive no matter what. But this is just important to understand where you're at and how you're moving, and then setting up those opportunities for yourself. And I just think people need to understand what's really going on out there. I think Burry's argument has merit, but I also think it's very, very early on to this. That's a personal opinion for me, because again, we know NVIDIA, based off their most recent earnings, of pushing this idea that they're going to be generating at least $500 billion going into the end of 2026. I think that does not indicate that there's a major issue just yet in this market. That's a personal opinion as well. Do what you got to do. If you have questions, comment down below. The Twitter link's down below as well. See you in the next video.